John the Rock Trading Co. on X says Chiefs win, gap up Monday. Eagles win, gap down. Surprisingly, there's actually some merit to this. If the AFC wins the Super Bowl, historically, that has actually led to a 19% return that year, going back to 2004. While pretty much every time Philadelphia has won a World Series in baseball or the Super Bowl, you've had very dramatic events happen, like 1929 and the Great Depression, or the '08 Great Financial Crisis, or 2018's stock market decline, which was the worst we had seen since 2008. Now, so far, the pattern for markets in the past couple of weeks is down Friday, gap down Monday, up Tuesday, Wednesday, Thursday, and repeat the process. That's why the S&P looks almost like methodical over the past couple of weeks. Gap down Monday, go up Tuesday, Wednesday, Thursday, down day Friday, gap down Monday. Go up Tuesday, Wednesday, Thursday, down day Friday, gap down Monday. Go up Tuesday, Wednesday, Thursday, bad day Friday, gap down Monday. And actually, on an annualized basis, Monday, the S&P would be down 95% for this year. So if Monday happened essentially every day of this year, you'd be down 95% by the end of this year. That's a wild number. Tuesday, if Tuesday happened every day, you'd be up about 77% for the year. If Wednesday happened every day, you'd be up 127% for the year. And if Thursday happened, you'd be up about 50% every day of the year. And Friday sitting at about 43% negative. But do me a quick favor before we get into all of this information. What could be in store for markets this week? Major catalysts like Jerome Powell's testimony in front of the Senate, as well as your CPI report and your earnings lineup, and much more. Only about 53.5% of you guys are not subscribed to the channel, that frequently watch this channel. That is less than 50% of you guys that are subscribed. Do me a quick favor, hit that subscribe button if you have not done so already, and let's get started. So first and foremost, as I explained earlier in this video, it seems like we have a bad day from headlines on Friday, and then we get more bad headlines over the weekend, gap down on Monday, retrace that throughout the week. Bad day on Friday, really bad headlines over the weekend, gap down on Monday, and we've kind of been in this cycle now for the past 3 weeks. This is actually setting up what is likely to be an opportunity because we haven't got much for bad headlines over this weekend. We're expecting to get new updates on quote-unquote reciprocal tariffs on Monday and Tuesday. As long as these tariffs are not on China, then I think the markets will do okay. I think we're kind of hyped up for this really bad news, or what could be really bad news. And if we don't get really bad news, that could likely turn out to be a positive for markets. I will also tell you from a technical perspective, if we don't have that gap down coming tomorrow morning, if the Chiefs win the Super Bowl, as some people think, well, if you could break this downtrending trend line we have now started, it could be like this break of the downtrending trend line. When you break these to the upside, it usually sets a new level. And this is what happened really from December 2024 all the way up until January 16th, 2025. Okay, where you had this downtrending trend line, you finally broke that, and then the S&P actually rallied about 2.5%, higher to new all-time highs. Okay, now whether or not that happens this week is really going to come down to the Fed and to a lesser extent earnings season. And of course, whether Donald Trump wants to put new tariffs on China or not. Now, if the EU gets tariffed, that's obviously not great. That's not the most ideal situation, but we could probably get over that, and there will probably be a deal made. We already seen some headlines on Friday that Europe was going to walk back or take down, I should say, their tariff amounts on US-made vehicles, which That's why like GM, Ford, they don't really sell vehicles in Europe because it's so heavily tariffed. It's like 100% tariffs on cars from America. So that was one concession already made by Europe. And honestly, again, I don't think Europe is too big of an issue. I don't think Trump is going to be too aggressive on Europe because their economies are in such a bad place. Kind of like China. We slapped 10% tariffs on China. China retaliated by tariffing like 80 different products. It wasn't seen as proportional by many people, which suggests that China's not really in a place to go into a trade war with the US. Their economy is not strong enough. And I think the same is true with Europe. So I think while investors are nervous about this will prove to be an opportunity. Considering that over the past year, let's just think about this. Over the past year, you had a 7% correction in spring of 2024, following 3 months of hotter than expected inflation and a weakening economy. Really fears of that double dip kind of inflation spike. It never materialized. Inflation started to fall off a cliff after those hotter than expected first 3 months. But you had that situation. You had the yen carry trade blow up where the NASDAQ was down 6% to start the trading day on August 5th. You did recover. You were only down like 3% to end that day. Overall, that was a 10% peak to trough correction. So you had that event as well in the past year. And you had Nvidia fall 17% in a single day. At one point was down over 20%, losing $600 billion in market cap value. And people thought the AI trade was, quote unquote, over with or severely damaged. In fact, what if I told you that we are now more bearish right now than we were in any of those other instances? You would say there is no possible way. No possible way. But in fact, that's where we are. As of last week, you had 42.9% of investors who are bearish. That is a 1-year bearish high. A 1-year bearish high. It almost sounds like it's not real. Because why are people that negative versus other instances in the past year? And that's where I think this ultimately turns out to be an opportunity for savvy investors. Now, Seth Golden writes on X, rarely are hedge funds found increasing market exposure to this degree at this time of the year. But man alive, down week for markets and hedge funds bought every single day last week. Now, again, we are expected to hear news on reciprocal tariffs tomorrow or on Tuesday. Now, that could be delayed to further in the week, but overall, I think the fear of that at this point is going to be, far worse than the actual reality. And I think that could be a buying opportunity because I don't think China is going to be tariffed again. I don't think the markets are really going to care too much for a 10% European tariff. Okay. Maybe I'm wrong. Okay. But that's just my opinion. I think the big market moving events this week will be within the data and the Fed. Now, starting off on Monday, because let's go in chronological order. Monday is before Tuesday. Monday, you have consumer inflation expectations, expecting those to tick up a little bit. Now, keep in mind, the Michigan Consumer Sentiment Survey on Friday showed 1-year inflation expectations that skyrocketed. But it was really skewed between Democrat and Republican respondents. So Republicans expect no inflation, essentially no inflation. Democrats expect almost hyperinflation, 5.5% inflation in the next year. A lot of it just has to do with the news headlines around tariffs and what that could do to prices, blah, blah, blah. Well, it's skewing the numbers that we're getting. So I think that was kind of a not justifiable reaction that we've seen in the S&P on Friday when you actually fell about 1%. I don't think it's nearly as bad as what the markets produced. Now, on Tuesday, we will get Fed Jerome Powell that will testify. Now, this is so important because CPI comes out on Wednesday. Now, CPI and the Fed. It's interesting because Fed Jerome Powell has confirmed before that they get important inflation data before it comes out. So CPI is already finalized right now, but we just don't have the data yet until Wednesday. The Fed has that data. So Jerome Powell is going to have that data heading into Tuesday. And that's important because, again, if you were going to get some kind of big inflation spike or big drop in inflation, something that would materially change the outlook for the Fed should probably know that before Jerome Powell testifies in front of the Senate on Tuesday. So what we get out of Powell on Tuesday is going to be a pretty good indication of the inflation report on Wednesday. If Powell is dovish, if he's talking about being able to cut rates this year and, the economy's doing okay, and we'll see what he has to say. But I think Powell could definitely skew towards the dovish side. I mean, look at Doge. I know it's a polarizing topic and the Fed likes to stay away from that, but the Fed will be asked about Doge and, how that's potentially going to impact the Fed's dual mandate. And I mean, from the employment standpoint of laying off 50,000 government workers, that's an issue. But from the inflation standpoint of reduced government spending and less waste and all of those positives, that would be good in bringing down inflation. So I think Powell could actually say some positive things and try to get, I want to say right with Trump and Scott Bessent, but it's not like that necessarily, but kind of get on their good side, acknowledge some of the good things and some of the progress that we could see on fighting inflation via Doge. So that could all come out on Tuesday. And I think overall, with markets as negative as they are, we're set up in a positive way heading into this week, as long as the Chiefs win the Super Bowl. Historically speaking, of course, that's just, I don't care who wins, but from a market's perspective, we're going to like it more if the Chiefs win, as weird as that sounds. On Wednesday, you will get your CPI report. Now, core month over month is expected at 0.3%. Last month was 0.2%. I think with expectations high, higher than last month, I actually think there's a very good chance that we come in lower than expected. I'll take the under versus the over in this circumstance. And I think that is positive, although I can't quantify exactly what the number is going to be. It just makes sense that inflation is continuing to decline. I mean, you're not really seeing inflationary pressures out there. It even seems like insurance pressures have started to abate at least a bit. Shelter has just went negative for the first time since Q2 of 2010. That's a very solid sign that shelter inflation is continuing to fall in the way that the government calculates inflation in shelter, which is homeowner equivalent rents. I could make a whole video ranting about that, why it's not the best way to calculate inflation, but it doesn't matter. We should make progress on inflation coming Wednesday. Core year over year is expected at 3.1%. What's actually interesting is, as the Fed has pointed out many times now, again, you had that big spike in inflation January, February, and March of 2024. So the inflation numbers that we get over the next couple of months, really over the next 4, 5, 6 months, should show a lot of progress on inflation, because you had this big spike and then it kind of wound down and you had less of a spike. But really over the last 6 months or so, you've had higher inflation. That should be, again, good for the headline around inflation coming Wednesday. You will also get a new testimony from Powell on Wednesday as well. But I doubt we'll get too much new information. It's probably going to come out Tuesday if we do get new information. Now, on Thursday, we are going to get PPI month over month. This is producer price index or producer price inflation. That's important because producers' input costs feed into to some degree what consumers pay. What's interesting is core PPI month over month last month was 0%. We're expecting 0.3%. That is a big spike on a month over month basis. I don't think we're going to see anything like that. So I think there's room for a downside surprise there as well. Initial jobless claims are expected to fall from 219,000 down to 215,000. Total household debt will be coming out. Last month was at 17.9 trillion. Not really a big market moving catalyst, but important to watch. Retail sales month over month for Friday will also be coming out. Expecting 0%, which we could actually come in lower than expected there, because a lot of companies, like even Elf, is saying after the holiday shopping season, there has been a lull in consumer spending behaviors for January. So we're expecting 0% month over month from December to January. I think that number could actually come in negative, and it could come in quite negative. So the setup for this week could be lower than expected inflation, worse than expected retail sales, which should kind of be like Goldilocks data for the Fed to turn more bullish. And I think that's one reason why we will get a more bullish leaning Jerome Powell on Tuesday and on Wednesday. But again, on Friday, you will get industrial production, retail sales excluding gas and autos, industrial production, manufacturing production, and business inventories that will all be coming out. Now, as far as your earnings setup for this week, you don't really have your big important earnings, not your multi-trillion-dollar companies, but you do have big companies nonetheless. I want you guys to think about specific sectors: AI sector, food sector, healthcare sector, semiconductor sector, software, AI sectors. Those are going to be the areas that can really move. The specific sectors, like McDonald's that reports Monday morning, that's going to move your food stocks. And after hours on Monday, you have Excelis, Vertex, Fluence, and Astra Labs. Not the most important companies, not really, important, companies that people invest in. I don't think a lot of you guys own these names. If you do, let me know down below in the comment section. Tuesday, pre-market, you have Shopify, Coca-Cola, Humana, BP, AutoNation, S&P Global, and Marriott International. Tuesday and after hours, Supermicro, Upstart, DoorDash, Lyft, Gilead, Energy Transfer, Welltower, and Zillow Group. Wednesday pre-market, you have Vertiv, CVS Health, Barrick, Generac, Biogen, Kraft Heinz, and Ryder. Wednesday and after hours, Reddit, AppLovin, Robinhood, Dutch Bros, Albemarle, Kinross, The Trade Desk, Cisco, MGM Resorts. Thursday pre-market, Datadog, CyberArk, John Deere, Crocs, Duke Energy, Sony, and GE Healthcare. Thursday and after hours, Coinbase, Twilio, DraftKings, Applied Materials, Airbnb, Palo Alto, Roku, Wynn, and Republic Services. And then Friday pre-market, Moderna, Enbridge, AMC Networks, and others. When you also take a look at 10-year Treasury yields, they have retreated from the highs of about 4.8%. Now, this was right before the inauguration that you hit these highs. And I think a lot of the decline in 10-year Treasury yields, yes, we've made some progress on inflation recently, but it does have to do with Doge and cutting back on government spending and essentially the government becoming less risky over time. And it's what Doge has already done, but it's what the government could do in the future that is starting to be priced into the Treasury market, meaning that investors, bond investors, are starting to expect more cuts to government spending, more financial, fiscal responsibility. Okay, more of a balanced budget, if you will, from the government, which means the government is less risky over 10 years. With less risk, investors, will start to buy more bonds and drive down the yields even further. And I think Jerome Powell on Wednesday, Jerome Powell on Tuesday, CPI on Wednesday, will likely also do this. So I think a drop in 10-year Treasury yields is likely coming in this week, which will be bullish for markets. And I really think a broadening of markets is likely coming. I think small caps, I think industrials, cyclicals, again, AI software, AI appliers. Though that's really going to be the area that you want to be in. I don't think it's going to be nearly as much large cap tech driven in our markets. And I think you could start to and continue to see the signs of this in this upcoming week. And again, we will have to see if we gap down coming tomorrow morning. If we don't, then that's kind of breaking the pattern. And if we can get above, again, this downtrending trend line here, that's going to set us up to make newer, higher levels in our markets. And I am optimistic following the extreme fear that we have and the overall negative sentiment that we have in markets today that we can move higher. After all, they say, bull markets are born on pessimism. They mature on skepticism. And they die on euphoria. And we are far from euphoric. We are very firmly in the skeptic stage. One would even say we're still in the pessimistic stage, which means potentially this bull market has a long way to go. So let me know what you think about this information down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.